Options trading can seem complex, especially for beginners. It's like a different language with terms like Greeks thrown around. Don't worry, we'll break it down simply. Options are contracts giving you the right, but not the obligation, to buy or sell an asset at a specific price by a particular date. This right comes at a price, which is the option premium. The value of this premium constantly changes based on several factors. This is where the Greeks come in. They are like tools that help you understand these price fluctuations. By understanding how delta, gamma, theta, Vega, and rho influence option prices, you equip yourself to make more informed trading decisions. Delta is like a speedometer for your options price. It tells you how much the options price will change for every 1-point move in the underlying asset's price. It's expressed as a decimal between -1 and +1. A positive delta means if the underlying asset's price goes up, your option price will also increase, and vice versa. For example, let's say you buy a call option on Reliance Industries with a delta of 0.6. This means for every 1 rupee increase in the price of Reliance stock, the option price will theoretically increase by 0.6 rupees. Now, delta is not static. It changes as the underlying asset's price moves. In the Indian market, understanding delta is crucial, especially for option strategies like covered calls or protective puts. For instance, if you're selling covered calls on Infosys stock with a delta of 0.3, you expect the stock price to remain relatively stable or increase slightly. Remember, delta provides a directional indication of your option's price movement relative to the underlying asset. It's a dynamic value, changing constantly with market fluctuations. Keeping a close eye on delta helps you manage your risk and make informed trading decisions. Now, remember how we said delta isn't static. Gamma measures how much delta itself changes with a 1-point move in the underlying asset's price. It's like the acceleration of your option's price movement. A high gamma means delta will change rapidly, making your option more sensitive to price swings. Consider this. You buy a call option on HDFC Bank with a gamma of 0.05. If the underlying stock price moves up by 1 rupee, the delta of your option will increase by 0.05. This means your option's price will become even more sensitive to further price changes in HDFC Bank stock. In the Indian market, gamma is particularly important when trading options with high volatility, such as options on Nifty Bank. For example, if you're long call options on Nifty Bank with high gamma, a sudden surge in the index can lead to a rapid increase in your option's delta, amplifying your profits. Gamma is a critical factor to consider, especially when holding options near expiry or during periods of high market volatility. It's a double-edged sword that can magnify both profits and losses. Understanding gamma helps you anticipate potential price swings and manage your risk effectively. Theta is the option's silent enemy, constantly eating away at its value. It represents the time decay of an option's premium. Options have an expiration date, and as time passes, the value of the option decreases, all else being equal. Theta measures this daily decline in value. Let's say you buy a put option on Tata Motors with a theta of -0.5. This means your option will theoretically lose 0.5 rupees of its value every day, assuming all other factors remain constant. As the expiration date approaches, theta increases, leading to a faster decline in the option's price. For options traders in the Indian market, theta plays a crucial role, especially for short-term trades. For instance, if you're selling covered calls on Reliance Industries with a short expiry date, you need to factor in the impact of theta on your potential profits. Theta is a constant reminder that time is money in options trading. It highlights the importance of time management and strategic decision-making when incorporating options into your investment strategy. Understanding theta helps you price your options appropriately and manage your risk effectively.